Breaking news coming in. The US Consumer Price Index has risen as much as 2.9% in December in the US. In fact, core CPI is at 3.2% year on year. In fact, according to what the analysts were saying, it was estimated to be around 2.9%, and that really has come in. The figure of 2.9% has remained unchanged. Now, how does this really compare to the November print? Well, in November, the forecast was 2.7%. The actual figure that came in was at 2.7%. So it has risen a bit marginally. But to decode all of these numbers and what does it really mean for Fed rate cuts coming up ahead, Fed's commentary, and the trajectory for the monetary policy, we're now joined by Geoff, independent and emerging markets commentator. Thank you very much, Sir Geoff, for joining us this evening. Help us understand what you really make of this data versus what analysts were estimating and expecting.
I think the positive surprise for the markets, which is why the markets are rallying and bond yields are coming down this morning, although not by a great deal, is the core number was better than anticipated. And so that, I suppose, is good news. But in fact, the headline numbers are picking up on a month-over-month basis. So there were 0.2 in October, 0.3 in November, 0.4 in December. The year-on-year rate, as you said, is around 3%, and the core year-on-year rate is also just over 3%. So as far as I'm concerned, all this data is doing is confirming that inflation is indeed stabilizing, but it's stabilizing above the Fed's target of 2%, stabilizing around 3%. And so I don't think anything we've had here in the CPI report makes it any easier for the Fed to consider rate cuts at the moment. And I think rate cuts from here on are a long way into the future.
All right. Geoff, also help us understand what is the rate cut trajectory that Fed is going to take, and what is the stance that the FOMC meeting will keep on rates, given that this is happening just barely days before Donald Trump assumes office?
Well, as you will know, the Fed is beginning to take account of the potential Trump policies in its statements anyway, and presumably also in its forecast. Now, the most recent dot plot from December is 2 interest rate cuts in 2025. And when I wrote my own outlook for emerging markets in 2025 about a week ago, I talked about 2 rate cuts in 2025 also. I think right now, with great uncertainty as to what Trump will do, how big and how broad the tariff increases will be, how big and broad the tax cuts will be, I think to get to 2 rate cuts this year will be very difficult. I think the call has got to be now somewhere between 0 and 2, and I would not be at all surprised if the Fed decides to keep rates on hold all year, unless, that is, the economy slows dramatically, which at the moment it doesn't look as if it's going to do.
Okay, Geoff, but what's the mood that you sense amongst investors now that, of course, many are estimating and expecting that there's going to be a single rate cut in the near future? How do you really see investors strategizing in the near term?
I think investors are very nervous, and I think they should be nervous. And I think this is just a small pop today on relief that the inflation numbers were not worse than people feared. And I think investors are very, very nervous. And I think the equities will probably sell off again and bond yields will certainly rise. I mean, I'm of the opinion that bond yields are going to go to between 5 and 5.5% for 10 years. And so I think this makes investors very nervous about taking on a lot of risk. I mean, as you will know, there's a lot of rotation going on in markets at the moment, equity markets, which is also consistent with a certain amount of nervousness on the part of investors. So in the US market, tech has sold off a bit, and there's been some rotation into more conventional stocks. And if you look at emerging markets, what is fascinating to me is that the big loser of the big 4 markets last year, Korea, is rallying hard this year, despite the geopolitics there. And India and China and, Taiwan are down on the year. So you're seeing rotation. Rotation is usually a sign that investors are nervous about pushing the current trend forward. So I would suggest that investors are quite nervous about the future and are being a little bit less aggressive in their equity positioning than they were for most of 2024.
Okay, Geoff, Let me expand a bit more on that point that you mentioned about volatility in the global markets and, of course, investors being nervous. Crypto as well, we've seen, is taking a dive. But do you really expect some sort of stability to kick in post Donald Trump assumes office? What really is your near-term view and mid-term view?
Well, a lot of people are dusting off an old saying from the markets, which is that you sell the rumor and you buy the news. In other words, you sell the rumor of Trump coming into office and all the changes he might do, and then you buy when it actually happens. I don't buy that at all. I think markets are more likely to be stronger in the medium term than they are in the short term. I think we've got a huge amount of uncertainty to come. When Trump comes to office, he's going to move quickly. He's probably going to move quickly on tariffs. He's going to lay down a bill, or a broad bill, I think, which will involve tax cuts, which is going to put the budget deficit at risk. It's already very high, and possibly higher inflation too. And so I think over the next 3 to 4 months, markets are going to be very choppy with a downward bias as far as I'm concerned. Later in the year, if the dollar were to peak, dollar I think is going higher from here. You will see some sort of rotation back into the emerging market. So I'm more constructive. I'm not bullish. I'm more constructive, more positive about global equity markets as you head towards mid-year into the second half of the year than I am in the short term, where I think there's a lot of uncertainty still out there about Trump in particular, but also about things, as you've mentioned, about Fed monetary policy. So I think this little pop we're getting in sentiment here today, and rise in the equity market in the US, fall in bond yields, I think that's all going to reverse pretty quickly.
All right. Thank you very much on that note, Geoff, for joining us and sharing your thoughts on what the December CPI print for the United States really means. And of course, you're saying that equity markets are going to remain choppy. There's been a bit of uncertainty now, but that is only going to escalate, at least in the near term. And of course, things could improve in the midterm. On that note, ladies and gentlemen, time now for us to slip into a quick break, but lots more coming up on the other side.